Good morning. My name is Melvin Escudero. I am the chair of the Advocacy Council for Latin America and the Caribbean markets at CFA Institute. It's really a great pleasure to have you in this morning to discuss one of the most interesting topics that actually we have in the investment world, geopolitical risk and market outlook. We have passed around 5 months since the beginning of the year, and probably nobody forecasted what is going on right now in the markets, especially the inflation, the conflict in Europe, and that's to call it very big political issues across the Latin American region. So first of all, I want to thank all societies committed to work in this regional effort. CFA Society Brazil, CFA Society Mexico, CFA Society Argentina, CFA Society Chile, CFA Society Colombia, CFA Society Uruguay, CFA Society Jamaica, CFA Society Bermuda, CFA Society Barbados, CFA Society Trinidad and Tobago, CFA Society Cayman Islands, CFA Society Bahamas, and CFA Society Peru. We are really proud to work in this effort to create events like this one that could help our members and our financial community to understand better what is going on in our investment world and to improve our decision-making process wherever is the area that our members are working. This panel is really very good. It will be moderated by Jorge Martinez, who is a board member at CFA Society Mexico. And we are very thankful also for our panelist, Marco Papic, who is a partner and chief strategist at Clock Tower Group, Luis Oganes, who is the head of global macro research at JP Morgan, and Andres Binelli, who is the chief economist at CFA Institute. We believe that a contribution like this level of speakers to our audience will be always welcome. But at the Council, we are continually working to create more opportunities, not only to understand what are the main trends in the markets, but also to create the networking and the union of our societies, following together the best practices in the markets, but also introducing very good concepts and ideas with our speakers. The next coming event in this month, we call it the month of capital markets. Societies like Chile, Argentina, Uruguay, and Peru have already committed to create webinars and conferences in person to contribute with the development of the local capital markets. This is, of course, a continuous effort, and we at the Council are very well committed. The 13 societies are fully committed to enhance the development of our markets. With this, I want to introduce Jorge Martinez. He is from the board of CFA Society Mexico to moderate these panels. Go ahead, Jorge.
Thank you very much, Melvin, and good morning, everyone. It's a pleasure to be here with you. And we have a lineup that is 5 stars, and I want to thank everyone who is with us this morning to discuss about the first panel, which is politics and economics in the investment decision-making for Latam and the Caribbean. And it will be full of a very rich discussion into all the things that are now on the table, especially uncertainty. We know that we now have a plate full of uncertainties, both in the markets and in the geopolitical arena, and also, of course, in the development of the economic dynamics inside each country, especially those who run the weight of growth, like China, the US, South America, and Europe, of course, Asia, and the place that has to be considered by the part of investors and fund seekers. So it's my pleasure to introduce the first panelist. He's Marco Papic, and he's the chief strategist at Clock Tower Group. He has an MA in political science from the University of Texas at Austin, and an MA from the University of British Columbia. He's the author of Geopolitical Alpha, an investment framework for predicting the future. Before Clock Tower, he founded BCA Research Geopolitical Strategy in 2012. He was a senior vice president and the firm chief geopolitical strategist. Marco began his career as a senior analyst at Stratford, and his academic work helped to create the Center for European Union Studies at the University of Texas at Austin. So, Marco, good morning to you, and thank you very much for being here with us. And we will be very pleased to hear your views in terms of all this risk that surround us. So please go ahead.
Okay, thank you, Jorge. I'm going to try to keep my comments to about 10, 15 minutes, and then we can have a good discussion. It's a real pleasure to be speaking with everybody today. So how do we put Latin America into a geopolitical context? And I thought about this a lot. I mean, there's a lot of things going on around the world, the war in Ukraine. There are political risks that some investors see in Latin America itself, the move to the left in many of the countries. And also there is the overarching sort of US-China competition. I was recently at a really interesting Bloomberg event in Panama, hosted by the Panamanian government, and the talk of the town, if you will, was what does Latin America do in this emerging US-China Cold War? Well, I'm here to tell you that you should do absolutely nothing. Absolutely nothing. Because there isn't a Cold War. That is a false narrative that biased Western American op-ed writers want you to believe, because it's easy to write about it. A lot of lazy analysts who don't want to think about the world and its complexities are basically holding on to the crutches of the last century. Also, none of us have experienced anything but either American hegemony or a bipolar system that split the world between two camps in the US and the Soviet Union era, the Cold War. None of us have experienced anything but this kind of a unipolar world of American hegemony or a bipolar world of a Cold War. The truth, however, is that the world throughout human history has most often been neither unipolar or bipolar. It's actually been multipolar, where no single or two countries are powerful enough to basically impose rules of behavior in other states. And so that's what I want to talk about today. I think that Latin America stands at the threshold of an incredible geopolitical opportunity. And not just Latin America, other countries as well. I think India is another country that could play this very well. And so far, I would say that they're probably the most adept at navigating the multipolar environment. They're very familiar with it, and I think they know what they're doing. Maybe some African countries, Middle East countries, I can see also becoming more aware of this. The danger for Latin America is that it has lived in the shadow of the United States for so long, and it's basically penetrated by so much American thinking that it may actually fall into the trap of thinking that it is a bipolar world, which would be a tragedy for the continent. So what do I mean by this? I'm going to share my screen here. And as I said, I'm going to fly through these slides, allowing for a discussion. I'm going to be purposely provocative and hyperbolic so that we can have a good discussion. The first thing I want to focus on is this chart. This is a chart that shows you the trade globalization proxy, basically imports as percent of GDP weighted by population. And as you can see, trade globalization does best when there is hegemonic stability, such as during the American hegemony, particularly in the 1980s and 90s. You can see the delta really increased here at the end of the Cold War, not in the early days of the Cold War, when between 1945 and 1980, the world was bifurcated between two countries. So if we are falling into a Cold War between US and China, we should expect a relatively tepid level of globalization. Also, Pax Britannica was very good for trade globalization as well in the late 19th century. Now, today, the problem is that we are no longer in this environment. The United States, relative to other countries measured by geopolitical power on the right, has basically declined relative to China, has lost a lot of power relative to the rest of the world, has basically been in the doldrums since 2000. If you look at the chart on the left, the GDP as percent of global, US relative to everyone else, the narrow gap here in 2001, the difference between US and the rest of the world's powers was basically 7%. Today, it's 20%. If you look at the bottom chart here, military expenditure as percent of global, the rest of the world has caught up to the US. So the preponderance of power is gone, and US policymakers are becoming aware of it, whether it's Donald Trump's America First policy, whether it's Biden's policy, whatever the case is, US is less of a global power. On the other hand, US has failed to create a coalition of the willing against China, which is confusing to many. I mean, again, we've been inundated with these op-ed writers telling us that there's a US-China Cold War. If that's the case, why have only 10 countries? 10 countries banned Huawei on 5G. Only 10 countries after two ideologically massively different administrations, Donald Trump versus Biden, both have pressured many countries to ban Huawei, and yet only 10 countries have done so. The one country that I forgot to shade here is Canada. Canada finally, after basically 4 years of deliberation, banned Huawei's 5G network. Now, this is just one anecdotal evidence, but it's a pretty important one because American policymakers have basically become obsessed with this issue. And they use it as a measure of success of creating a coalition of the willing. This is a laughable coalition of the willing. And that's why my title is George W. Bush Laughs at Your Coalition of the Willing, which of course is a dig at the Iraq War. Now, there's a reason for this. It's not American incompetence. It's not Chinese power. No, it's actually something else. The world is neither unipolar nor bipolar, it's multipolar. And when the world has no clear leadership, what happens is something very interesting. Enemies end up trading with one another. It's very difficult for any one country or any two countries to enforce a set of rules and norms. It's very difficult for one country to create a global trading regime, as the US did from 1985 to 2010. And it's very difficult for two countries to split the world into two camps, bifurcating the world. Now, the late 19th century, early 20th century was a similar environment of multipolarity. In the chart on the left, I've been showing this chart for 5 years, making this point, highly controversial point. I think I was the only person on this corner, basically arguing there would be no bifurcation of trade, and there hasn't been any. The chart on the left shows you that the total trade between France, UK, and Russia with Germany, their military enemy. Let me remind you, if you don't know your history, France, UK, and Russia had a military tripartite alliance against Germany. It was very clear to everyone there would be a world war at some point, very clear to everyone. They all knew they would go to war with Germany eventually. For 20, 30 years, this was clear. And yet, look at this chart. Trade kept going up right up until the war. Similar thing happened between Japan and US in the 30s. Again, both countries knew they would eventually fight for control of the Pacific, and yet trade went up after the Great Depression. We have some modern examples of this too, by the way. Japan and China in 2012 had a very serious dispute, almost went to war over the Diaoyu Senkaku Islands. As you can see, there was a clear drop in Japanese exports to China and FDI inflows in China, and they've actually recovered since then to basically their peak, which is very interesting and I think important. Why is this the case? This is the case because there's an inverse relationship. We're not an inverse, but a non-linear relationship between distribution of global power and economic integration. And there's a lot of political science literature, including game theory, really sophisticated game theory research that obviously no investor has ever read, incorrectly in my view. But there is a very non-linear relationship between these two issues. So a unipolar world, and just to explain this chart, on the x-axis is degree of global anarchy. The lowest level of anarchy is, of course, a hegemon, a superpower that imposes rule and law on the rest of the world. A bipolar world is, some anarchy, but relatively, we reach an equilibrium between two bullies in the schoolyard, that splits the schoolyard into two. And then finally, a multipolar world, which has the most anarchy. What's interesting is most investors would assume that multipolarity is the worst for globalization, for the degree of economic integration, but that is not the case. And it's not the case because allies cheat on each other. This is an important point. allies, military allies that are committed to going to war on each other's behalf will cheat on each other in a multipolar system in trading with the enemy. Now, here's a really dramatic example of this. In 2020, Australia was the first country to demand that there is an investigation into the origin of COVID-19. And as punishment for that, China basically banned exports of Australian barley, wine, cotton, timber, and coal. You can see that Chinese imports of these goods from Australia, the purple line, basically fell. Now, which vile country, which enemy of Australia came in and picked up the slack? Well, it was no other than the United States of America. And you can see this incredible inflection point at this point when China punished Australia, America's probably #1 ally when it comes to China. When China punished Australia, it was America that stepped in and stole Australia's cookie from its cookie jar, just sold Californian wine, cotton, wine, barley, and all the other imports. Excuse me, those are the sounds of LA that you're hearing in the background. So the point that I'm trying to make here is that in this multipolar environment, Latin America has to be very careful. Committing itself to any one camp would be a tragic error. And the most important issue for Latin America is to become geopolitically promiscuous, something that India has mastered over the last several months. And I would argue that the current sort of a, view out there that the Ukraine war will create two clear camps is massively false. China has been very reticent to support Russia. In fact, I would argue India has supported Russia diplomatically and economically even more, even though it's part of the Quad against China, very confusing. And I would argue that in 6 months, Europe will take a cold shower and realize that its transatlantic alliance has done nothing to prevent the war in Ukraine. In fact, you could argue that American foreign policy contributed to the conflict by basically giving Ukraine the hope that some support would come if Russia did invade. So where does this leave us? First of all, we know from political science theory and empirics that a multipolar global order is the least likely to produce an equilibrium. You can see this on this chart that's already happened. This is a chart of number of interstate and internationalized global conflicts. Political science theory was right. The last 10 years have seen the highest level of conflict since World War II. Saying that Ukraine has changed the game is basically borderline idiotic. Only if you haven't been paying attention to geopolitics over the last 10 years do you think that Ukraine is somehow a catalyst for anything. It isn't. Ukraine and the war in Ukraine is a symptom of a global context of multipolarity that's not going anywhere. And that conflict will reinforce this. Really quickly, geopolitics is not the only good thing for Latin America. Not only does it offer Latin America the ability to play different sides of one another, it also creates a context for a commodity bull market. Now, there's many reasons why there's a commodity bull market. Certainly, geopolitics is not the #1 reason. There's the energy transition. There's the demand for metals, for copper. There's the green technology demand. There's all sorts of things, lack of capex over the last decade, and so on and so on. Emerging markets relative to US, we know what the performance has been. It's been terrible. And yet, if you look at commodity prices and developed world imports, we are at 2-decade highs of both. At the same time, the performance of currencies in emerging markets relative to the US dollar has been in a long down cycle. I think that we are coming to the end of this for a number of different reasons, including geopolitical multipolarity, but more likely the fact that the US is about to start losing both the growth differential and inflation differential story against the rest of the world. Finally, in our view, the correlation between equity markets in Latin America and copper, especially in the Andean Latin America, Peru, Chile, is very high, and assets have yet not caught up with a high level of commodity prices. So there's a tactical reason to be very bullish on Latin America, which is commodity supercycle. And there's a more longer structural story that Latin America can play both sides in this very interesting geopolitical context. So I'm going to stop there, let the other speakers have their time, and then have time for a discussion. Thank you so much.
Marco, thank you very much for those deep thoughts and very fresh ideas into what could happen in terms of also the geopolitical arena. I sent you two questions, and one of them is already answered. There's no just two blocks like Africa with China and Russia against the world. That it's been written recently about it, but you clear out that wouldn't happen. It's more like a multipolarity, as your thesis, and it's really interesting. But my second question, I think it holds, and goes like this: is nearshoring also something that has been written about recently a lot? A reality, for example, for our countries. Mexico will export more now that people come back from where they fear things are going to go to the south. Maybe Europeans will come here and put their plants in the north, and also in Peru and Brazil and some other places, just to get away from the conflict. Would that happen? I mean, it's of course there is evidence, at least in my country, in Mexico, we see that there's investment coming. But is this part of a trend that is scaring away investment in the conflict areas and bringing it nearer, as the name, nearshoring? Would you say that has also a trigger after or before the war or another war? This is the first question, Marco.
Well, just on the question of the two camps that I answered, that's just my view, but Jorge, I would say that I'm very lonely in the camp that thinks that it isn't a bipolar world. And I would argue that most people who are in that camp just aren't looking at empirics. But that's, obviously my perspective. Now, on the question of onshoring, I'm going to show you a chart here from a different chart back that I haven't shared with anyone yet. But exports as percent of world total is really the only way to think about onshoring. That's the only real way to think about it. Thus far, there's absolutely no evidence of nearshoring or offshoring. Zero. There's anecdotal, this company did this, blah, 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 blah. Well, that doesn't matter. Okay, so this is a chart that I focused on India, and you can see exports as percent of world total. China has actually grabbed market share, grabbed it. Now, the usual standard answer is like, Marco, it's the pandemic, people are buying goods. Yeah, it's the pandemic that the US president, the president of America, accused China of starting. So if there was bifurcation, why didn't we jack up tariffs to 80%? If supposedly China started COVID, there was the clear political moment for the president of the United States of America to begin that nearshoring and onshoring. That didn't happen. It didn't happen. Now, over the long term, I do agree that China will become less important in the global supply chain. I think this move is unsustainable. But I think that it's very dangerous to assume that every country in Latin America will benefit from that. India, for example, has not benefited at all. And it was one of the theses for why India is the best performing equity market over the last 2 years, by the way, better than the US. And I cannot point to any nearshoring happening in India. The two countries I am bullish on, Mexico, for sure. Mexico lost out when it signed NAFTA because right after that, China came and stole its bacon. That's going to be reversed now. I'm bullish on Mexico and Brazil. Brazil will succeed in nearshoring, though, not because of this. Brazil will succeed because of green shoring, something that Brazilian policymakers should jump on as soon as they can. Europe is going to have to impose a green import tax because of its carbon credit system. The EU Commission will roll this out in the next several years. And when that happens, countries that produce electricity at a high level from renewables will be able to not have to pay that import tax. And guess what? Large economy produces the most of its electricity from green sources. It's Brazil. So I would put a bet on those two countries, but not really anybody else in the region.
Great, great. There's a question from Dan Glickstein here, a friend in our chat, and he's referring to friend shoring, and it's partially answered by your previous answer, Marco, and he says, well, you restrict trade with foes. Well, maybe that is kind of already answered by what you think. But there's another question about Sebastian Sensacqua, and he's asking about the reserve currency that represents the dollar and the yuan. Is there a weaponization of the dollar could hurt the U.S. in the long term? This is his question. What do you think about the dollar, Marco?
I think if you look at the UK pound experience in the late 19th century, It basically went from about 67% of global reserves to just under 50, from 1885 to 1914. And that was what happened in a multipolar environment. I think the same thing will happen to the US dollar. US dollar is now 59% of central bank currency reserves. It's used more in trade, by the way, than that. I think it can drop under 50. But I think it would be a mistake to expect it to lose reserve currency status. That's going too far. I think there will be just more of a multipolar currency mix. Look, the US is still the first amongst great powers. That's very clear. And as such, its currency will continue to be the main currency reserve. But I do think that there will be some erosion over that time. As for the first question, like friendshoring, I don't see that happening. I don't see that happening in a sustainable way. I think there's reasons to move to Mexico that aren't just because Mexico is a geopolitical ally of the US. I think there's transportation advantages, labor advantages of China are being withered away. But I think that the chart from the 19th and 20th century proves very clearly in a multipolar environment, it is very difficult for allies to stop trade with enemies because their own allies will stab it in the back. Think about it this way. If America stopped selling Boeing airplanes to China tomorrow, what do you think Airbus would do?
Yeah. And besides, you need long-term bonds in yuans, and that is not yet here, right?
Oh, yeah, for the currency.
For example, yeah.
Yes.
Thank you very much, Marco. Those are the questions. It's been a pleasure to hear your views, and those are very fresh ideas and a lot of food for thought. Thank you so much. Let me introduce everyone. Andreas Vinelli, he will be our second speaker, he's chief economist at CFA Institute. He earned his bachelor in economics from Universidad de San Andrés and his master's and PhD in public policy from Harvard University. As a member of research, advocacy, and standard leadership team at the CFA Institute, he works to augment cross-departmental and cross-functional or regional research. Before he joined CFA, Andres was the Vice President of Economic Policy at the Center for American Progress, and also he assumed before the position of Chief Economist at two world-class financial regulatory bodies, FINRA and PCAOB. So Andres, thank you very, very much for being here with us, and we're looking forward to hear your views also, and I'll have my questions ready also. And also there's already questions from the public.
All right. Thank you, Jorge. Thank you, Marco. What I will do in a few minutes is to shift gears a little bit towards economics from geopolitics, and go over some big trends out there. And I hope to open up for questions and debate. And also, I think it will be fun to take a more bearish stand on the situation and see what happens. So here's the roadmap that I'm thinking. I want to go very quickly over some trends that are important after the COVID epidemics and what it means for our economies. And then I want to go into what's going on the two big locomotives of the world. It's not a bipolar world, I think, but US growth and China growth matter. So I want to get a little bit into what's going on there. Then we can chat a little bit about the Ukraine situation, and finally see where everything comes together. I think that one overall message that I want to give is, in much of this hemisphere, the winter is coming. It's June and the winter is coming. That doesn't mean that everything's going to be dark and stormy. There will be places to shelter and to prosper, but we need to do work to make sure that we identified which of these warm and toasty places are, and shelter in those. So it's a great time to be a stock picker. It's a good time to be an asset allocator. This is going to be fun, I believe. Let me share the screen with you folks. Okay, so First of all, the pandemic got us in a place that was already changing. The world has been changing for a while. Basically, we have been in a world with slower growth and with rising economic inequalities, which matters on a variety of topics here. There's the underlying trend of climate change and the policies to abate them. The political environment in many countries has been polarizing, and there's a lot of discontent with governing elites. And we had seen, even before COVID, a trend towards more managed trade, and geopolitics are more and more volatile. Now, COVID, in many ways, can be seen as an accelerator of many of these trends. Basically, we have seen that public spending has gone up dramatically to combat the effects of the virus. Of course, this has been uneven around the world, but largely speaking, we're in a higher debt world. And of course, supply chain disruptions. There's been a decrease in migration. Also, technological innovation has affected profoundly our response in terms of how we work and how particular sectors do conduct their business. I'm thinking education. So many of these things are accelerating, and the economy is changing on us. And that's a theme that perhaps it's can be obvious on many levels, but I think it matters a lot in explaining how policymakers react to this evolving reality. Now, the U.S. Basically, as we look back to the end of last year, we had basically in the U.S. a year of very high growth, a lot of employment creation, and basically under unemployment that is fixing itself. Lots of people were on the sidelines of the job market for a variety of reasons. But basically, what we are seeing is what they call a Robin Hood labor market, where basically the blue collar type sectors of the economy were doing a lot better in terms of wage growth than the higher end, which was sort of a break in the underlying trend we had seen for decades in most places, especially in the US. Now, if we fast forward to projections at the end of this year, basically what we are seeing is that GDP growth will go back to quote unquote normal, probably somewhere between 2 and 2.5% growth by the end of the year. That is, for you golfers out there, is par for the course. That's what the US grows like lately, to maybe 2.5%. So we're back to some kind of normal for that metric. The labor market is also getting to be, pretty much normalized by the end of the year. Unemployment basically will keep being 3.6% or something along those lines, which is very low. It's like 5-decade kind of low. Of course, the big topic is inflation, and we'll get into that in a minute. But the projections basically say that we're going to be at the end of the year around 4% inflation, which is on the way to being completely normalized. But the mood here is that inflation hurts. Everyone seems to be unhappy. People are venting in many ways, and basically government popularity is down. Mostly, I would say, because of that. Now, the response to the COVID crisis. This is my favorite graph showing what happened here, which is, if one thinks of growth as a linear thing, basically what happened in the great financial crisis in 2008 is that we went down in growth. That was very, very painful. And what happened after that is that we kept on growing, but basically we never rebounded to the place where we were before. I mean, the trend seems to be more or less the same. So the yellow line basically shows that we're on the same trend. We just lost something and never made it back. Now, if you compare and contrast with what just happened on the COVID crisis, take a look at the right-hand side of the screen. Over there, we see that it looks like we are going to be better off than before, in the sense that we will not have permanently lost all that output that we lost during the financial crisis. Okay, we rebounded, and not only, well, we'll see about the slope later, but we are not basically losing what we had. So that is huge from an economic perspective, and it's something that it's not widely appreciated yet. I don't think it is in public discourse, but this has been, from that and say, successful policy intervention. Of course, there's a downside, or there's several downsides. The costs have been basically on the fiscal and the monetary side. Debt to GDP is up for the US, and you see a big jump during the COVID crisis, and then slowly going down after that. But also the balance sheet of the Federal Reserve has swelled, and that's something that is it's going to be a challenge to undo over time, and not without risk. So basically, those two charts show you the cost of this policy actions. Marco talked about the dollar. I will skim through that, but suffice it to say that now we are in a situation with very strong dollar, and that's something that is important for Latin America, as we'll see. Now, what does it, in which ways does it matter for us looking at the Caribbean and Latin America? Well, inflation, which is high in the US, and commodity prices basically challenge, food, shelter, and energy, which is the basic needs of people out there, and that's going to hit basically the region. It's a problem. It's going to drive discontent. Okay. The second thing is the macroeconomic growth. The U.S. is going back fast to normal. Okay, and after that we'll see what happened, but there is some risk of recession, and of course the financial markets are in bear territory and all that. So those are risks for us. Now, of course, the good thing about a strong dollar is that it provides an opportunity for people who export to the U.S. So that's a good thing. Now, couple of things about Russia. I'm not going to go into all of this, but basically, as everyone is aware, we're seeing projections of negative growth for Russia. To some extent, it doesn't matter much because Russia is big, but it's not huge, right? And the demand side of things don't matter that much. Of course, energy matters a lot, and commodity prices and wheat in the Ukraine and all that does matter. I invite you to check out the newsletter of the CFA Institute, a Systemic Risk Council, that goes a little bit into the types of risks that we are seeing to that. What I want to emphasize here is the issue of financial markets. I want to talk just a little bit about that. If we see some sort of default by Russia, which is, it's certainly in the cards as possible, defaults have unpredictable consequences. Remember, in '98, it triggered the fall of a big hedge fund, and that required basically policy intervention by the New York Fed in an indirect manner. That's an issue there. So that's in the backdrop. Let me go to China. The only thing that I want to say about China, as I want to open to questions, is that it used to grow by a lot. Now it's not growing by a lot. Okay, we are basically seeing a big slowdown in the Chinese economy. Probably that's a temporary thing, but think of what that does to aggregate demand. And of course, there's supply chain issues due to the COVID response over there. But this big increase, this big growth in China, now, we're talking about 4, maybe 5% for the year, which is very low for China, and that we're gonna feel in many ways. Now, the main thing that I want to focus on is interest rates. Here in the U.S., they're going up, and that is bad news for the region. Former Brazilian President Cardoso, Fernando Henrique Cardoso, used to say something to the effect that basically you look at the Latin America economy, and 2 factors are important: interest rates and commodities. Okay, we talked about commodities. It's a good story about commodities, but interest rates, boy oh boy, that's going to be a challenge. Every time that interest rates go like that, a market somewhere blows up. That's, history of the world. That's what usually happens. We'll see what happens this time around, but something does blow up. There's an interesting article on the Financial Analysis Journal. If you're a CFA, you have it for free, so check it out. It looks at the unwinding of carry trades. That's one of the things that is happening, and that's a dangerous situation. It doesn't have to be, but we're going to see flight to quality to the US market, and we're already seeing some consequences. Cryptocurrencies have been hit, of course. There might be more problems happening. So what I want to say at the end of the day is that interest rates are a big determining of the economic performance. Yes, commodities matter. The effect is going to be very localized. So I would urge everyone to sharpen the pencil and look country by country rather than the whole region. The commodities impact on energy and soft and hard commodities will be very differential to each country. This is a great time to be a market analyst, an asset allocator, a stock picker, because the winter is coming, but there will be warm places and places that will be able to thrive. Now it's your job to assess each of those situations on your own. So with that, I will go back to Jorge. Jorge.
Thank you so much, Andres. A very interesting presentation. Thank you for your ideas. And yeah, we confront a world in which, at this point in Europe and the US, wages are growing less than inflation, and that loss of purchasing power is going to affect, of course, a lot of things in the economy, and that will be very, very interesting. Let me kick the Q&A section to the last part of the presentation. So I will leave pending some of the questions that I have for you and some others that have come up here. And let me introduce Luis Oganes, and thank you again, Andres, and we will back to you with the Q&A and also Marco. Luis, muy buenos días, good morning to everyone. Let me introduce to you Luis Oganes. He's the head of the Global Macro Research Group at JP Morgan, with a PhD at NYU, and economist at the Universidad de Lima. He has been a part of the JP Morgan New York and London. He's in charge of the teams that analyze the dynamics in economics, political, and market forces to identify investment opportunities in markets, exchange rates, raw materials, and sovereign debt of emerging economies. He was a teacher of economics at NYU, researcher at the World Bank, and economic analyst at the support group in Lima. So thank you very much, Luis, for your time, and we will be happy to hear your view. Yeah, recently the boss at JP Morgan said that things were hard. So I don't know if you share that view with him, but it will be great to see how hard, how soft, how exaggerated are all those fears, or maybe they are right on the spot. So please share with us your views. Thank you very much, and good morning, everyone. We'll leave the Q&A after your session.
Thanks, Jorge, and good morning, everyone. A pleasure to be joining this very interesting discussion. I asked actually to be last when I saw the slides that both my fellow panelists, Marco and Andres, were going to show, because I thought, okay, you know, I'm going to try to land some of the concepts that they're going to be sharing to Latin America, and where we see the outlook for the region, and what can we hope for or expect for, given all the various moving parts happening at the global level. Before I go, you know, to discuss the outlook for the region itself, I would like to comment on how geopolitics in general has become a lot more of a risk that investors globally are being called upon to monitor a lot more closely. Certainly, you know, for us, economists coming from the side of, you know, looking at countries as sovereign analysts and looking at whether a country, you know, will have the capacity to pay or the willingness to pay, these tended to be the first two questions that you ask in order to, you know, invest in a country if you're an investor, or recommend investing in a country if you're an analyst. Well, guess what? Those two elements are no longer sufficient. You also need to look at geopolitics, because something can happen that can alter whatever the fundamentals on the, you know, creditworthiness front are telling you, or, you know, whatever the willingness to pay notions are really incorporated in the analysis. Let's put an example, you know, Russia. Obviously, you know, we know what has happened, the dramatic and sad events in the last couple of months now. But you know, from a pure, you know, sovereign investor perspective, an investor that was long Russian bonds just before the invasion. Obviously, there were signs that the invasion could happen or not. It was anyone's guess. But if you look at the fundamental picture for Russia, you know, it was a country that had a public debt to GDP of only 18%. It had a current account surplus. Obviously, oil prices were already high before the invasion, so the external accounts of Russia were already benefiting from that. You had, you know, rather conservative both fiscal and monetary policies that were anchoring in a way the credit story there. And on the back of all this, you know, the bonds were trading at $120 basically, $1.2 for every dollar of debt. And guess what? Within 2 days after the invasion, bonds dropped to $20, right? From 120 to 20. So, ouch! You know, big time losses for those that were long Russian debt. Yes, the warning signals were there, but the bottom line is that hey, you know, even a country that has this, you know, quote unquote magnificent balance sheet, you know, $600+ billion of international reserves, you know, you could still be in a situation, you know, as Andres said, you know, very close to an actual sovereign default, despite having that kind of balance sheet. Why? Because of geopolitics, right? The sanctions are being imposed, the restrictions, the inability of Russia that honestly still wants to pay, you know, is trying to look for ways and mechanisms to deliver the coupon payments and the principal payments that are coming due. And yet, you know, more and more of the doors are closing. Obviously, the US is driving a part of this process. But again, from a very abstract point of view, this is a new type of risk that investors are needing to monitor. A couple of other things on the sidelines of this, and some of these also came up in the presentation of Marco and one of the questions. You know, guess what? Having a very strong position of FX reserves may not necessarily be a good insurance for, you know, your capacity to pay debt because of sanctions. You know, and there's obviously a lot of discussion in the markets of what does it mean for the future. You know, does it mean that the countries are going to be looking to accumulate the reserves in currencies other than the dollar? Very hard. You know, we agree with Marco. What Marco just said before. You know, we may see certainly more diversification going forward, but there doesn't seem to be right this minute for sure a currency that can replace the dollar as a reserve asset of central banks around the world, of the planet. So, you know, this is going to be something to watch, but certainly the inclination and the motivation will be there to look for alternative ways of keeping these FX reserves in the future. Another one is ESG. Interesting enough, Russia actually had good ESG scores. Why? Because it had a 50-year plan to reduce carbon emissions in its economy, at least on paper, that led it to have, the kudos from those that are coming up with these ESG scores, ESG ratings. But so a lot of the emphasis was on the E, the environment pillar of ESG, but the S and the G, the social and the governance indicators, were kind of overlooked. And we're seeing the decision made by Russia to invade Ukraine, and that is where a lot of probably the analysis should have been focused, to maybe have a stronger, higher probability that an event of this like this could happen, and maybe that could have altered some investment decisions ex ante. Obviously, that's too late now. But I think that going forward, we're going to see more of a focus for those investors that are looking at, are trying to align their portfolios with ESG pillars on the S and the G, not just on the E. And geopolitics is going to be driving a lot of the considerations that are captured by these pillars. So let's try to land some of these concepts to Latin America. I want to echo as well something that that was mentioned before by Marco. Latin America, in a way, is in a good position to benefit from some of these shifting waves, shifting tides in global geopolitics. Unfortunately, we don't see a political class in our region that is, in a way, even thinking about this or looking at the big picture and looking for ways to have their own countries benefit from this, or to position them to attract capital flows or more investment to take advantage of this kind of dynamics. The first one is the most obvious one, right? With this, Russia-Ukraine situation, commodity prices that were already going up, partly driven by, the energy transition, the decarbonization pressures, the net zero pledges around the world. There was already an issue with pressure on commodities, but certainly Russia-Ukraine, to the extent that there is a high share of oil, of natural gas, of many agricultural commodities, of metals coming from Russia, and some of them actually as well from Ukraine that cannot be exported right now, is putting a lot of pressure on commodity prices, and that doesn't seem to be about to end anytime soon. Even if there is some kind of peace settlement on the road, hopefully sooner rather than later, I think that there's going to be still, the sanctions are unlikely to be lifted promptly, which means that the need to replace the production, the exports coming from Russia would be there. And Latin America produces a lot of what the world is, needing to buy right now, where prices are up because of scarcity. And Latin America, what we're seeing is that, actually the wave, there's a protectionist wave in the region. If you look at the governments that are being elected, are winning on platforms that are promising, to a little bit more autarky. So basically a reversal of the liberalization wave that dominated many countries in the region in the 1990s or in the first decade of the 2000s, which is unfortunate, because this is the moment when Latin America should actually be, in order to take advantage of this, should be the region that is opening up more, just out of self-interest and promoting more trade, opening up a lot more rather than adopting more protectionist measures. Unfortunate to hear that in some countries that there's a willingness to revisit trade agreements and the like. So that is one thing that where Latin America hopefully would not miss this opportunity, but so far the signs are that it may. The second one that was also mentioned before, this decoupling that we are seeing, at least at a rhetorical level, if not in actual trade flows just yet, between the US and China, right? There's certainly, and this is a bipartisan posture in the US, both Democrats and Republicans, they don't trust China. They're looking for ways of, how do you disengage, making it more difficult for Chinese investment in the US, making it more difficult for US investment in China, making sure that transfer technology are under control, etc. So, there is at least a decoupling objective. Let's see how far it can go. Out of practical reasons, it may not go too far, but at least there is a motivation. Certainly, companies, clients, corporates that we interact with, they do say that it's just become a lot more difficult being a foreign company operating in China. So, from that perspective, other countries, should be actually looking for ways to attract, the potential redirection of these investments that are now that are based in China, that are looking for ways to diversify away just in case, right? And Latin America is interesting. So far, we haven't seen that happening. Certainly, beyond, as was mentioned before, beyond the anecdotal, the region, even though it could be the prime beneficiary of this dynamic, has not seen that so far. Mexico stands, front and center as the country that would benefit from this. But if you look at the dramatic decoupling between the U.S. manufacturing cycle and the Mexican manufacturing cycle over the past year, it is remarkable. How the U.S. is actually overheating. That's why the Fed is hiking. Mexico should, growth should be much, much stronger than what it is right now, and it's not. Why? Because there is a poor business environment. Certainly there is quite a bit of distrusting of the private sector, in the policy stance of the AMLO administration, and that shows up in the willingness of Mexican or foreign investors to invest more in Mexico. So obviously this can still be reversed, but again, hopefully this will not be a missed opportunity. So I would say the U.S.-China decoupling and the high commodity prices that are going to be driven both by the energy transition, decarbonization efforts of the entire world, and the impact of Russia-Ukraine conflict, hopefully are things that Latin America, gets it stands up to try to benefit from. I also agree with something that was said before. Then Latin America is in a position that doesn't have to choose in this in this world that is trying to pull things. You're either with me or against me. It can trade both with the US and China. It can certainly, try to attract investment flows from both countries. And again, it should be the region should be the exception to what we're seeing this, all this talk about deglobalization. Well, Latin America should be on the opposite side of it, just to benefit, just because it has the production that and the products that the world needs right now. Hopefully that will happen. Let's see what comes next with the recent wave of governments that are getting elected. So let me switch to the outlook for the region, and for that, let me just give a summary of what a global picture is. Well, certainly we have a situation of that it looks like we're in what we call late cycle dynamics, where labor markets are extremely tight, central banks, inflation is high, central banks are being called upon to remove policy stimulus and tighten monetary policy in order to contain inflation, and that has we have seen this movie before, right? And the hope is that central banks, particularly the Fed, but this applies for every central bank in the planet, they can strike the right balance between tightening monetary policy, generating some kind of quote unquote soft landing without pushing economies into recession, which has obviously more of a cost, economic cost in jobs lost and the like. But it is a fine balance to strike, and oftentimes it's not possible, and given where inflation is right now, that is still not quite anchored anywhere, with inflation still surprising on the upside in the US, in Europe, certainly across emerging markets, it feels that, most likely the central banks are going to need to do more rather than less. And there is obviously the open question whether this ends up eventually generating the much feared recession. The issue with recession is, again, every economic cycle ends in recession, right? So there's almost like a cyclical inevitability of a recession. The question is, when it happens and how deep it goes. And the hope obviously is that it doesn't happen immediately, that is still maybe a year or 2 years away, and that when it happens it's a shallow one. Now, what is it that this time around is different from previous cycles, and this is a result of the pandemic, is the fact that a typical element of late cycle dynamics is high leverage. Companies, up to their necks of borrowing in the bond market or in the loan market, individuals, households also, with quite a bit of, mortgage debt or credit card debt or consumer loans, etc. And this time around, we're not seeing that. Actually, balance sheets of both households and corporates are rather clean, and they were the leverage levels were reduced during the pandemic. So during the time that we were all locked up, not able to move because of COVID, there was quite a bit of policy stimulus, policy support, government programs trying to help companies make sure that they don't go bankrupt and fire people. Programs as well to support households, right? Because a lot of people could not make a living, and there were all kinds of furlough programs or direct subsidy programs. And because we were all still locked up, a lot of that money actually was not spent. So the savings level in the world going into 2022 is actually rather high. And that is why we're still seeing a rather remarkable resilience in global growth, despite all the shocks we're seeing, right? The shocks of policy tightening financial conditions, the Russia-Ukraine impact on generally speaking, on sentiment, on commodity prices, on food prices, the fact that central banks are hiking, China decelerating because of its own zero tolerance policy, etc. We're not seeing growth nosedive. There's still quite a bit of resilience, particularly on the consumer side, be it in the US, but I would extend that to also the emerging markets and even Latin America. Lumping it in this dynamic. So the biggest question this time around is, when will the cushion provided by these high savings will be exhausted, and then we go back to the normal traditional late cycle, right? When the central bank hikes rates, eventually, immediately you start to see an impact on labor markets, obviously lower growth, higher unemployment, and then of course we end up in recession, and that's when inflation stops. So far, inflation is still strong. Why? Because consumption is still strong, demand is still strong. All this resilience is because of the high savings rate. So that, I think, is going to make the reading of the tea leaves this time around as to what comes next a lot more difficult. To finalize my comments, just to summarize, where does Latin America fit in this puzzle? So growth is normalizing this year. Last year, Latin America grew at 6.6%. This year is going to grow only at 2.1%, much closer to its potential growth. So there's a big deceleration. So not much to celebrate there, although there's quite a bit of variance within these numbers. The economy that is growing the most is going to be Colombia, actually 6.5%. According to our projections, I think that the official number is less than that, around 5%. The economy that is going to grow, potentially the least is Brazil, 1.2% only this year, and that is partly because of the high inflation and the fact that the central bank had to push the brakes quite a bit and almost like engineer a technical recession in the coming quarter. So that gets reflected in this full year growth numbers. But overall, 2.1%, again, it's very close to potential for the region. So in the grand scheme of things, the number is not as bad as you could think, given everything that we've been discussing here in terms of the global shocks that the world and Latin America are experiencing. Certainly, high commodity prices is helping many countries, those that are obviously net exporters, but as well is hurting many countries that are net importers. And here is, several Central American countries where are not net commodity importers, or of course the Caribbean, that are importing both energy and food. And that is where a lot of the challenges, probably lie in the months ahead. So again, when we talk about Latin America, oftentimes we think about it as a block, but there's quite a bit of divergence within the region. So we cannot just say that high commodity prices is good for the region. Yes, it is very good for the net commodity exporters, but there are a number of countries that also suffer in this kind of episode. Latin American central banks are not done with monetary tightening. I would say that most of them that have inflation targeting regimes still have more work to do. There is an open question, though, as to, okay, with inflation reaching high single digits, or in some places double digits, how far can monetary policy tightening go? Is the objective to generate real positive policy rates? If you do that, you wouldn't probably need to take the policy rate to double digits, and that would certainly kill growth, right? So there's an open question as to how much more tightening there will be. Our expectation is that central banks, what they're doing is that they're not trying to accomplish reach the inflation target, certainly not this year. An open question whether they can still meet it in 2023. So they're going to be kind of extending the horizon for meeting the inflation target, hoping that they tighten enough today or in the coming months to contain inflation expectations, to keep them anchored, so that and to wait for inflation to do its thing, which is with growth acceleration and with time to start moderating, and eventually with the tightening that has happened, reach a real positive rate that can certainly keep inflation expectations anchored. It is an expectations game. Credibility of central banks matters a lot in this kind of situation. And of course, you know, there are some central banks that are more permeable to political pressures than others. So it remains to be seen how the market behaves in this environment. For governments, I think that the pressure is still going to be there to help populations with dealing with high food and energy prices. Commodity prices for those that are exporters are providing at least some kind of fiscal cushion to help offset some of this, but not every country is in that position. So, you know, we will have to expect probably more political dramas generated by the high inflation, right? Because not every country is going to be in a position to offer some offsets to their population. And then something that was already mentioned before, you know, populism in Latin America, we say that we invented populism, you know, a couple of decades ago, and then the whole world took it up. Guess what? Well, there's another populist wave sweeping through the region, and this is right wing, left wing. You know, in the end, populism, you know, coming whatever political bias there is, you know, remarkably, it meets at the same place, which is policies that are, you know, obviously short-termist in nature, and that unorthodox, and that you know, maybe solve things in the near term, but it generates problems for the medium term. So we can only hope for the best, but certainly the political tide is generating as well, you know, quite a bit of anxiety for investors, because with all the things that could go in the right direction, favorable for Latin America in this you know, multipolar world of shifting geopolitical tides, that the region certainly has a lot more to take advantage of. But most, you know, it is possible that domestic politics in the end gets on the way, or there is no one, you know, looking at the big picture trying to take advantage of this. So I guess time will tell. Let me stop there, Jorge. Thank you.
Thank you very much, Luis, and for your views, and very interesting. It complements a lot of what Marco and Andres were also saying. So we can start with a Q&A question and answer session, and we already have some questions that we didn't make to Andres and Marco. I'm going to start with you, Luis. There's a quick question here from myself, just on a follow-up of your view. Recently, Jamie Dimon said that there was coming some kind of hurricane. I think that's the word he used. What do you think made him change his way of looking at the world and the markets? Because just some weeks before he was more constructive. Would you say that it's inflation that scared him off a little bit, or yeah, please, I don't know, maybe you've discussed this internally.
Well, I think, well, I don't know exactly what prompted, you know, the timing of his comments, but the one thing that we noticed is that over the past month, there was all of a sudden, you know, more talk about, you know, the U.S. economy showing some signs of deceleration, and maybe that could lead the Fed to stop a tightening process, right? And on the back of that, we saw Treasury yields declining. If you look at 10-year Treasury yields, declined during the month of between, I believe, May the 6th and May the 27th, like 40 basis points. And you're like, why? You know, and when you look at the inflation dynamics, when you look at the savings rate that is still high in the U.S. that I mentioned before, when you look at the implications of the war on commodity prices, the possibility that, you know, so far there is very little demand destruction that is happening in the U.S. on the back of the increasing gasoline prices. Gasoline prices on average are close to $5 in the U.S. We think that this summer is going to reach probably $6. That's going to add in itself maybe another 1 percentage point of inflation. So it doesn't feel that the conditions are there for the Fed to even think about stopping a bit. The Fed just started hiking, right? So I think that his comments were more like a wake-up call to the market. It's like, hey, don't believe, I don't know what people are thinking, but the type of pricing, and we saw a rally even in emerging markets, right? The emerging market local currency bond yields declined 30 basis points on the back of, this 2-3 week episode. And we're like, well, from our perspective as country analysts and strategists, we recommended to our investors to fade that move, that, just don't believe it, right? It's not sustainable. This rally is not sustainable. So I would say that overall, eventually there will be some deceleration. I don't know if it will be a recession. I don't know if it will be a deep recession. Many elements tell me, and this is my personal view, that when we see a recession, it will not be as deep, just because the starting point of a high cushion of savings is going to prevent a big crisis, right? So certainly there's not a lot of debt to default on, which helps compared to the mortgage crisis 10, 15 years ago. But the timing is uncertain, right? I don't think that it will happen this year. Can it happen in the second half of the year? It is possible. Can it be in 2024? It is also possible. So it is very difficult for the markets to position today for something that may happen a year from now or 18 months from now, right? So I think that we're going to see probably, a lot of, what we call it bear market rallies, right? So you're going to see rallies and sell-offs. It's not going to be straight line, which is obviously tough for investors, because, you want to capture all the kinks of this performance, which is, difficult to do. And there are so many moving parts that, you just need to diversify and hope to get lucky with part of your portfolio, knowing that in some other part you're probably going to lose money. But again, I think it's too premature to be calling for, the quote unquote Fed put, the Fed stops tightening, and that, you see a relief rally, So I think that probably the comments from my company's chairman was probably related to a wake-up call that, hey, don't believe this.
Yes. Well, yeah, that's understandable, and yeah, talking with my clients, some of them are really clueless on what to do, because things resemble also moments in the past, but not exactly, as we know, and it's been quoted from Mark Twain. The history repeats. Not all the time, but it does rhyme. So there's a question that I have for Andres, and this precisely on that point. Andres, inflation in the 70s was very, very high, and this inflation that we're looking at right now is higher than the one we saw in 2006, and that led to a recession, and also the one that we saw on the 90s. Well, in 1990 or 91 with the war and all that. And it also led to a recession. And this inflation, the peak that we've seen up to this point, is higher than those two. We have to go to the 70s to see higher inflation than those two moments, 2006 and 1990. Does this inflation causes the same havoc that happened in the 70s for a lot of stocks? Is this a moment like that one, from your point of view?
Short answer is that it's most likely that it's not, and I'll go into that. I want to say something about that precautionary call by the Damon. Complacency is the risk here, in my view. We have been faced with shocks that are unique, and no one knows what's going on. I think that should be the premise of our analysis, right? And the type of world that we are seeing, the Fed, is trying to play catch up. Policymakers around the world playing catch up. And in a world where there's not a Cold War, not a one power overwhelming, dictating terms for everyone else, in this more multipolar, or whatever the word exactly is, there's more room for errors, right? There's a lot of unilateral relationships, and people can make mistakes. And I think in this, in a certain environment, the chances of that are a lot higher, right? So now going back to the issue of the 70s and polyester pants and all and disco balls, are we going to see those again? I don't think so. I think that yes, there's some similarities, right? The monetary policy was very loose before the shocks in both cases, right? Inflation went up, then you need to catch up and swallow some hard medicine and all that. So there's some vague similarities, but I think that basically three things are different in this case. I mean, they could turn for the worse, don't get me wrong, but so far three things are different, right? One is the size of the shocks, right? It was like a lot bigger. What happened with oil in the 70s was a lot bigger than what happened, here. However you look at it, of course, this could change, right? So last time was worse, but so far, the size of the shocks is, quite different. That's issue number one. If issue number two, the type of economies that we have today, totally different from the 70s. Think what you may of it, but they're more globalized, more technology intensive. Unions, labor unions were a big deal in the 70s. Not anymore, frankly, in many countries, right? So the things are less indexed, to inflation. So dynamics are easier to inflation dynamics are easier to cut. There's more international trade. Of course, there's, like, who knows what's going to happen. Maybe it goes down a little bit, but we're starting from a high level of international trade. So inflation can be cushioned that way, right? This is something that wasn't the case in the 70s. Plus, there were like fixed, exchange rates, other things going on. And finally, the other thing is not only the shocks are different, but the economy is different, but the central banks are a little different, right? Central banks know how to deal with inflation a lot better. Not perfect, of course. We're all trying to catch up here, right? But there's been a lot of credibility that has been built. It is more clear than ever. I think that fighting inflation is of central importance for, central banks. So I think that it's likely that unless, there's more independence on the margin than there was in the 70s, but if you're a central banker, of course, all these three things can deteriorate, right? And we might as well get somewhere there, but is that the more likely scenario? I don't think so. I think we're seeing, in the US, we're close to the peak in inflation, and now it's the slow and not steady, but slow decline. The question is, will we see a hard landing in the US? Likely no, but it could happen because policy mistakes and mistakes of all sorts are a lot more likely than they used to be. Thank you.
Yes, and a follow-up, Andres, is the Fed more tolerant to high inflation now? They might be 400 basis points behind the curve, they say, according to Taylor and things like that. Would you say that they are willing to be more tolerant? Yellen has certainly said so, but I don't know. What do you think?
It's hard to tell, right? It's like, I don't know. I'm not inside their heads, right? What I do know is that, for decades now, the worry was deflation, right? So they were wrong, on the upside, right? They wanted more inflation. They couldn't do that. And now they want less inflation. We'll see if they can do that, right? But there's a change. There's an academic debate, it's not that important, I think, but it's like, should the target be maybe 3 or 4% rather than 2%? And there are good merits to that argument. I don't think they're going to switch that regime as they fight this inflation. That would be like changing horse in the middle of the river, right? In the middle of the stream, probably a goofy idea, right? I don't think they're more tolerant. I think that the politics favor, a hawkish stance here. I'm sort of optimistic that it can be done in the sense that already financial conditions are tighter, and also the fiscal drag. I mean, like, we spent a lot, which might be an issue, right? But now we stop spending, and that creates a natural vacuum that is deflationary. It's bad for growth, but it's good for inflation. So I don't think there's a lot more tolerance for that. I mean, politicians hate, if you look at the misery index, it kind of, in a way, overweights inflation pain, and people hate paying more at the pump, right? People hate paying more for milk. They see it every freaking week, right? It's not like buying a TV you do every 5 years and God knows what you paid last time. This you see every week. So people are very intolerant to inflation for good or bad reasons. So I don't think that they're going to be more tolerant than that. But I'd be very, very curious to know whether Luis and Marco or Jorge, you agree with that.
Thank you, Andres. And there's a couple of questions here about Latin American region in specific. For example, there's Ernesto Cuadros asks about the long-term productivity in Latin America and the consequences that it will have on other markets. He refers to this problem as the eternal problem. So anyone, I don't know, Luis or Marco, would like to answer to that one.
What I can say from my side is that unfortunately we haven't seen that many reforms that are productivity enhancing in the region. Certainly even before COVID, we saw the region sliding, growth was sliding, and it was a tail end of the end of the previous, commodity super cycle, right? During the super cycle, of course, all the economies were growing at a very high pace, but it was being basically driven by commodities. When the music stopped, you saw a sharp deceleration and potential growth. We were marking down potential growth everywhere because there was no offset coming from productivity enhancing reforms. Now we have again, another commodities. I don't know if it's a super cycle that is going to last 10 years or it's just a couple of years. Who knows? Time will tell. That may provide some cushion to the region, but it feels that the beta is not as strong as the beta 15 years ago because the region is not buoyant right now. Maybe it would be a lot worse if it wasn't, commodity prices were lower. But I would say that, I hope that we can see, more of a reform agenda in the region to enhance productivity. Back to the comments that I made, right? The region is in a prime location and a prime, even geopolitical situation of trying to attract more investment if it was, if you had a little bit more of an illustrated political class.
I think one thing that,
yes,
yeah, if I can just add, I think, technology could enhance productivity to some extent. I mean, we haven't seen productivity growth in the US over the last decade, really. So technological contribution to productivity, there's I'm a skeptic. I'm a little bit of a Luddite, but in the 90s and the 2000s, there was. And I think Latin America is 10 years behind. And so when you see a lot of the really interesting fintech companies and a lot of SaaS businesses starting to focus on Latin America, focus on the market, we as a firm are actually very, very excited about that. And we think that's something that will be an investment opportunity and should also contribute to productivity growth.
Thank you very much, Marco. Inigo, do we have time for another question, or shall we close?
Yes, I think we have another. You can ask another question.
Okay, great. Thank you. Yeah, there's a question here. I want to cluster several questions about the geopolitical topic. So I will direct them at you, Marco, if you're okay with that. There's a question from Augusto Valdivia about Europe and the debt, the sovereign debt crisis that could come, with this, especially in Germany, he says, and also very related to that is the implications for Europe about the unorthodox policies in Turkey. So those two, I don't know if you would like to tackle them. Please do.
Actually, Turkey is an interesting situation because we are seeing polls really move very strongly against the incumbent AKP and President Erdogan. So, it's not something that I would want anyone to get overly excited about. The election is still 12 months away. But it does seem like Turkey is approaching the Macri moment, if I can put it into the Latin American context. And that makes me very excited. I think there could be a geopolitical alpha opportunity emerging in Turkey. Overall, Europe, I'm actually quite bullish on Europe over the long term. I think there's a definitive cycle shift from the last cycle. Last cycle was very much a dollar everything bull market, tech dominated. It was a disinflationary macro context. I think we're flipping away from that. And that means that if you have to be in developed markets, you want to be in those markets that are going to have, equity sectors that are not overly exposed to tech. It's not a disinflationary cycle anymore. I do think that Europe can innovate, not necessarily on SaaS businesses, and they've proven pretty incompetent on that front. But when it comes to some of the big epochal shifts we're dealing with, such as the green energy transition, such as moving away from fossil fuels while still extracting them, industrials, those are sectors that actually Europe does, they dominate the European continent. And finally, I think that by the end of this year, Chinese policymakers will probably have to break glass and pull the infrastructure spending lever. If they haven't done it already, they will by the end of the year. Europe is a derivative, it's a high beta play. It's a derivative of what happens elsewhere. Europe is not a price maker, it's a price taker of the macro environment. And I think by the end of the year, the macro environment will probably be much more conducive for investments in Europe. Finally, politically, I think political risk in Europe has been overstated by 20 years, mainly because people in Latin America and North America read everything about Europe through the British press, and so there's a constant bias Euroscepticism. Made my career, quite frankly. The easiest call I ever made was saying the Euro area wouldn't break apart. Easiest call I ever made. And that continues to be the case. Every crisis we've seen over the last 20 years has actually increased and deepened European integration. A multipolar global environment is actually conducive to deeper integration. And so I'm, not particularly bullish anymore because I think the market's properly pricing lack of risks on that front, but I do think that continues. So I think Europe stands to win the next decade in some way, and valuations, I think there is an advantage there as well. Although, of course, I would caveat, this has been the widowmaker trade. I mean, I don't know how many macro strategists have gone to their grave saying buy European banks. So I'm not going to say that. Buy European industrials instead.
Good. Thank you very much, Marco. And thank you. I guess this is the moment to cut the Q&A session. Thank you very, very much, Luis and Andres. It's been an honor and also a pleasure to hear your views. It's been a great discussion. It fit me a lot, and I guess our participants in the same way. So I will leave you with Íñigo Bengoechea. He's a Senior Director of Government Affairs for the Latam region in the CFA Institute. And thank you very much for your time. And Íñigo, please.
Thank you, Jorge. It's a pleasure. And let me now give the closing remarks. And thanks to everyone who participated in our Geopolitical Risks and Market Outlook webinar for Latin America and the Caribbean. And thank you to our panelists, Marco, Luis, Andres, Jorge, and Melvin, who provided wonderful insights into these very important topics. Simply put, I guess the biggest takeaway for me from this webinar is that geopolitical risks are here to stay and that they will be with us for quite a while. The world has changed, and Latin America and the Caribbean are not immune to these risks and are already seeing the effects, as many of our panelists commented. Investors in the region, of course, need to pay attention to these risks because geopolitics will continue to drive important market moves. So stay tuned and continue to watch the markets. Finally, let me say that this series of webinars are the result of the collaboration amongst 13 CFA societies across Latin America and the Caribbean. And without them coming together, this series of webinars would not be a reality today. So therefore, my sincere congratulations to our societies and volunteers, as well as Melvin Escudero for his leadership as chair of the region's Advocacy Council. The good news is that we're planning to do additional events this year on other important topics for the markets. And please stay tuned as we work together in bringing you high-profile speakers in charge of driving market trends. So with that, thank you again and have a wonderful afternoon. It's great to see you, and thank you again.